Welcome to my channel. In this video, I'll be discussing an article regarding Silicon Valley Bank collapse, explaining what Silicon Valley Bank is, why it collapsed, how this will affect other banks and what it means for everyone else. Let's get started. On March 10th, federal authorities took over Silicon Valley Bank, the greatest US bank failure since the global economic downturn crisis of 2008. The bank had served to many of the world's biggest technology capitalists. But, on March 12th, regulators were worried about New York's Signature Bank, mostly due to the bank's significant exposure to the volatile cryptocurrency industry. Currently, the FDIC has taken over management of both financial institutions. Last week, investors rushed to remove tens of billions of dollars from Silicon Valley Bank, prompting regulators to declare the takeovers. The whole financial sector is feeling the effects of the crash. The stock of small, regional banks has taken a beating, the bond market has been volatile, and the Federal Reserve is under pressure to slow the pace of its interest rate rises despite persistent inflation. There's a lot going on here. Here's the lowdown on it. Throughout its 40-year existence, Silicon Valley Bank had achieved remarkable success despite its relatively modest size in comparison to other major financial institutions. SVB served high-net-worth individuals, entrepreneurs, and venture capital organizations in the Santa Clara, California area. It had established itself as a formidable competitor to more well-known financial institutions in the booming technology industry. They really established a specialty that became the pride of the banking world, said Jared Shaw, a senior consultant at Wells Fargo. They are capable of satisfying the requirements of high-end clients such as technology firms, VC firms, and PE firms. Companies in the technology industry and related fields were among its clientele. They included Roku, Roblox, and Vox Media. It turned out that its over-reliance on the technology industry was a major contributor to its collapse. But for the past week, it had a relatively low profile outside of the IT community. I hope you enjoyed the video so far. If it was interesting for you, please don't forget to like and subscribe the video. This helps me a lot for my future videos. In spite of the epidemic, computer businesses had caused a surge in business for Silicon Valley Bank. Customers deposited more than $100 billion into the bank's coffers. The SVB invested billions of its 2021 cash surplus in long-term U.S. Treasury bonds at a time when interest rates were historically low. U.S. government bonds have a reputation for being low-risk and conservative investments. Long-term bonds are safe until interest rates rise, but only if held to expiration to get the entire payout. And this is precisely what the Federal Reserve did in 2022 when it started raising interest rates rapidly to combat rising prices. Federal bonds, such as those owned by SVB, lose value as a result of these rate hikes. The issue was that, being long-term interest rates, they weren't worth their face value. The rate of interest increased. They were forced to sell them below cost, financial expert and University of Chicago professor Douglas Diamond told NPR as much. And this whole situation might have been prevented if only the supervisors had stated, "Hey, we recognize interest rates may be going up." This wasn't an issue as long as SVB wasn't short on funds. In contrast, the whole technology industry has been on a downward trend for the past several months, and businesses have been pulling their money out of the bank in growing numbers. SVB announced last week that it had to sell $1.8 billion in bonds at a significant loss to cover the withdrawals. Because of this news, SVB's customers became concerned for the bank's future and began pulling even more money out of the institution, exhibiting all the classic symptoms of a bank run. Shares of SVB Financial Group Incorporated, NYSE, SVB, fell by more than 60% on Thursday as customers rushed to withdraw a total of $42 billion in deposits. As of Friday lunchtime, the FDIC has taken control of SVB. When compared to SVB's bond investments and exposure to the technology industry, those of other banks are much more secure. Even nevertheless, the bank robbery caused widespread anxiety in the financial industry. Shares of financial institutions of all sizes, including the major banks, have dropped in the past week. On Monday, the stock prices of other banks that were thought to share some of SVB's concerns fell precipitously. First Republic Bank's stock price fell by more than 60%, while Western Alliance Bancorp's shares fell by almost 50%. Investors were concerned that other lenders, particularly smaller and regional ones, might see a similar rise in redemptions and fail to fulfill the demands of their investors. Traditional financial institutions like JP Morgan, Wells Fargo, and Bank of America have all seen significant declines during the past week. Silvergate, a California-based bank that serves the cryptocurrency sector, declared its intention to close down earlier this week. Moreover, on Sunday, regulators took control of Signature Bank, a New York-based institution that entered the cryptocurrency market in 2018. This comes after the bank experienced $10 billion in withdrawals on Friday, the day after SVB ran into problems. After last year, crypto took a major knock. The banking industry as a whole is expected to remain robust in the long run, according to experts. Morgan Stanley bank analysts wrote in a report late last week that SVB's problems are very distinctive and should not be considered as a read across to other smaller banks. "We'd like to make this absolutely crystal clear," they stated. "We disagree that the financial sector is experiencing a liquidity crisis." According to Wells Fargo analyst Shaw, panic selling affected other financial institutions as well. He said that the anxiety in the market was caused by little more than a single event but was now feeding on itself. FDIC authorities have assured the public that all SVB depositors, even those with balances in excess of the $250,000 maximum, will have unrestricted access to their funds. The vast majority of SVB accounts held amounts larger than that. SVB's $175 billion in client deposits are effectively insured by the move. Signature Bank deposits will likewise be insured, they promised. On Monday, both financial institutions resumed normal operations, restoring customers access to their money. That should allow businesses that have to make payroll, among other regular expenses, with money deposited at SVB to continue functioning normally. The FDIC has stated that shareholders and some creditors will not be insured. The upper echelons of management have been fired. Government authorities are acting to stop the contagion from spreading to other financial institutions. The financial system is secure, Vice President Biden stated in a press conference on Monday morning. In case of emergency, your deposits will be available. Funding has been made available by the Federal Reserve Board to other institutions in an effort to strengthen their cash holdings, which should help prevent another bank run. Yet, the market reaction was substantial on Monday. The day was filled with ups and downs on the U.S. stock market. When investors sought the relative security of government bonds, their prices rose and their yields fell. The two-year yield on treasuries was hit the most, as it most closely reflects investors' projections for future interest rates. Its yield has fallen by a whole percentage point, from only over 5% to just below 4%, since the midst of 2 weeks ago. It's all occurring before the Federal Reserve decides whether or not to raise its benchmark interest rate at a meeting next week. Inflation has been tempered by the Fed's quick interest rate rises during the last year. Yet, bond holdings have declined in value due to the increases, including the billions of dollars in SVB invested in bonds that contributed to the bank's demise last week. The financial markets had anticipated a 0.50 percentage point increase in interest rates from the Federal Reserve at its March meeting before SVB's collapse last week. Now that the Fed is under pressure to slow the pace of its rate hikes, those projections have receded. Beyond the first signs in the banking industry, it is clear that we do not know the consequences of the recent, very quick growth. And I believe the Fed would do well to wait and see the outcomes of their actions before taking any action that may make things worse, according to NPR's interview with Barry Ritholtz, head of Ritholtz Investment Management. Okay, that was for today. Thank you so much for watching the video. Please don't forget to like and subscribe to not miss my future videos.